In 2021, interest rates were rock bottom, and VCs, venture capitalists, were keen to invest more capital into startups. Silicon Valley Bank, SVB, was the bank of choice for them and their clients to hold their deposits. As the name suggests, they specialized in this niche of startups, and according to data from 2015, which is a little bit out of date, 65% of all startups in the US used SVB for their banking. Now, probably expecting that rates would stay low, SVB took these deposits and invested them into long-dated treasuries. Not necessarily something out of the ordinary for a bank to do. They're relatively safe, highly liquid, can be sold if needed, and they pay some interest. But then 2022 happened. Inflation hit peaks not seen in decades, and the Federal Reserve started raising rates at a pretty fast pace to try and combat it. Now, when the Fed does this, or there's an expectation that they'll do it, it will cause other rates in the economy to rise as well, such as those bonds that SVB had been investing their deposits into. Now, just in case you're not familiar with bonds, you don't know how they work, basically, the price of the bond has an inverse relationship with the yield on the bond. The yield is the interest rate that you receive for holding that bond. Now, on the open market, where you can buy and sell bonds, if interest rates in the economy are rising, that means the yields on those bonds are less attractive, and therefore the price of the bond is going to reduce. And boy, did interest rates go up that year. So that means that the bond values that SVB were holding were declining and heading into a loss. But all of this wouldn't have mattered that much to SVB if they were able to hold their bonds to maturity as the long-term investment that they were intended to be. They would never have to sell bonds in the open market at a loss because they can hold the bond to maturity, get repaid their original capital, and receive the interest payments along the way. So those losses would have been paper losses and they would never have had to be realized. But that's not what happened. You see, higher interest rate environments are not great for startups, SVB's main types of clients, and so withdrawals started to hit SVB. Now, for a traditional bank, this wouldn't usually be an issue because they have more diversity among their clients, some companies, some individuals, and therefore there'll be more liquidity coming in as deposits as withdrawals are going out, so it's not an issue, it's kind of in balance. But for SVB, with a heavy focus on startups, the withdrawals started to outweigh deposits, and they needed to sell some of their bonds at a loss to cover the withdrawals. Even after this, the amount of low-interest bonds that SVB still held had an unrealized loss of $15 billion, meaning they hadn't done a good job of hedging against interest rate risk. But the credit rating agency Moody's noticed this and were preparing to downgrade their credit rating. As a result, SVB sold a bunch of bonds at a loss to improve their balance sheet. But this caused some panic among VCs. They feared that the bank may run out of cash for withdrawals, so they began to advise their clients to withdraw their money and to move their deposits elsewhere. A run on the bank was imminent. Now, a bank run happens when a large number of people lose confidence in a bank and withdraw their money all at once. This can be sparked by rumours or news of financial trouble, which can cause a domino effect as more and more people try to withdraw their funds at the same time. Now, the problem with a bank run is that banks typically don't have all of their customers' money on hand. Instead, they use it for investments and loans and things like that. Now, if too many people try to withdraw their money all at once, the bank will run out of cash and be forced to close their doors. This can have a devastating ripple effect on the economy as people and businesses lose access to credit and the ability to conduct transactions, leading to a wider economic downturn. This was seen during the financial crisis, a few years after that during the sovereign debt crisis in Europe, and of course in the Great Depression, as shown in my mum's favourite film, It's a Wonderful Life.
Go hand over all our cash. All of it. Every cent of it, and still was less than we owed them.
Holy mackerel.
And this is what SVB were facing. To cover the withdrawals, they were having to sell even more bonds at a loss, and by that afternoon, their stock price was in freefall, also bringing down other bank stocks with it, as investors began to fear that another 2008-like crisis may be on the horizon. On Friday morning, trading in SVB stock was halted. Regulators came in and placed the bank under the control of the FDIC. Now, it's too early to know for sure how big the scale of this is that we're facing right now. Fortunately, the early signs are not pointing to anything like the 2008 crisis. Big banks like JP Morgan are usually more diversified, and troubled banks are usually more specialized or regional, like Silvergate, which focuses on crypto, although it's not on the same scale as SVB. However, SVB is still a major bank, with many businesses choosing to deposit there. It's the second biggest bank in US history to collapse, and if those depositors find that they can't access their deposits, that could end up in massive layoffs and a big shock to economic growth. Governments, including central banks in major economies, are currently working to find a solution. They were working over the weekend. The UK arm of SVB has been purchased by HSBC for £1, which means that the government doesn't have to step in to protect depositors, so crisis averted there it seems. However, no such deal has happened in the US yet, at least at the time of recording this, although things are moving quickly. For now, regulators in the US have guaranteed that depositors will be able to access all their cash, even if it's uninsured, as a big worry was that the FDIC only protects up to $250,000, but businesses generally have much more than that, well into the hundreds of millions in some cases. But still, this has rippled through the markets, and current price moves suggest that people think that the Federal Reserve may be about to stop raising rates and even begin cutting in May. However, the labour market is still strong, inflation is persistent, so it's possible the markets have overreacted. This is still a developing situation though, and all eyes will be on the governments and regulators to see if they can reassure depositors at other banks and avoid any more bank runs. Or perhaps in a worst case scenario, this could just be the beginning, like a new century type moment from back in the financial crisis. Doubtful, but time will tell.